Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of June the 24th, 2024. Now, to get started this week, we'll begin again with that very important US dollar index, pretty much everything revolving around interest rates these days. So, in our trading, the point of these presentations is not just to talk about technicals, but also bring fundamentals in because fundamentals drive the market in most cases. Specifically, in this case, is interest rates. So, last week we looked at our Fed funds futures, and we'll bring that back up so we can see after the PMIs and some of the other very mixed data that there is only a 10% chance of a rate cut in July. When we move into September, that's come down slightly to 65.9% probability of a rate cut. But November and December remain strong at 78% probability of a rate cut. And in December, we're looking at 94.8%. So the wild card here would be September. But again, the Fed is, in my respectful opinion, is getting backed into a corner. The data does not support higher for longer. It does not support holding at these rates, basically. So we'll leave that at that. But this brings it into perspective. The fundamental that we need to monitor each week. We can debate what the Fed should or shouldn't be doing. That's a separate argument, guys. What we need to focus on is what are the probabilities going forward. And when we look into January of next year, this is a pretty clear picture. January 98%, March 99%. So we always want to make sure that if nothing else, we're getting out in front of these moves. So right now, the dollar has responded to the PMIs being slightly higher. Nothing significant here. The indicators in VP are very, very mixed. Our MA diff cross is still warning that this move higher is likely not sustainable here. So we want to make sure we understand that. We have a significant verified resistance up to 105.74. This is the area to keep an eye on. Now, in most cases, the trend from Friday continues into Monday. And then on Tuesday, we see things reverse. But always remember, we are moving towards month end where the dollar is predominantly strong anyway. So I would be looking for a little bit more dollar strength. But if anything, it would probably be the week after next where we see that dollar strength. So again, our MA diff cross is down. Now, some had asked about the short term, the T cross short. So what you can do in your software is you can bring in any one of these you want to bring in. So, but just remember that shorter term indicators very often produce false signals. As you can see right here, the short term, the T cross short is, there's a crossover took place there. So again, what I would strongly advise that if you're using the T cross short, that one of the best ways to use that is gauging when the market is out of fair value. The further the short term, the T cross short moves away from our anchor point, our T cross long, the less likely the market is going to continue higher. So right now, our T cross short, it could extend a little bit higher, but again, that's not always indicative of a stronger trend. Very often, it's showing us the exact opposite. So again, we look for it to move out of fair value like it did back here in April, and then we look to play the MA diff cross. But again, if your short-term bets on the dollar are on the long side, I would not dispute that, but the medium and long-term bets are definitely short against the dollar. So when we do a comparative into our gold contracts, once again, you can see that gold responded to that data. But that's only one data set, guys. But again, I will stress the importance of adding fundamentals to your technical trading. It's a must, actually. So again, when we look at gold, China's not the big player here for buying gold. India is, and India's been buying it up heavily, and I don't believe they're going to stop. So right now, the structural bias of this is 2066, but the area that I've been discussing over the last several months actually is the quarterly opening price is the important one. 2233, which I believe represents a very good buying opportunity if we can get down into those levels. Right now, the indicators in VP are sitting at a potential breakout point to the downside, but we need the predicted RSI moving below 40 to signal we have downside momentum. But either way, I believe gold will be contained by 2233, and that would be a buying opportunity again. We just need confirmation in the indicators. So once again, if you want to manipulate the triple cross, then you can certainly do that by adding a shorter term indicator here. But we want to use that in conjunction with the main tools here. So right now, you've got a lot of choppiness with that short-term T-cross long here. And again, this is a weekly outlook, guys, not a daily. We do look at tools like this, and I would encourage anybody using the VP software to look at the live training room that's on Monday, Wednesday, and Friday, where we get into short-term trading strategies. But that's not what this presentation is. It's a weekly outlook. That's why we have the hard anchor point of the T-cross long. That area now is 2355, but I believe that this is the data that came out on this past week is only short-term data. We have Michigan confidence next week, I believe, GDP. So there's always data each week, but some data is very important and some is not as important. So the PMIs have pushed gold down a bit, but I don't believe it will keep gold down for any length of time based on the fundamental that again, from the Fed's own words, rate cuts, there is no pathway to rate hikes. It's higher for longer or cuts that should keep gold firm in the near term. Now, when we look at the S&P 500, once again, a pretty strong week, but when we look at, again, the T-cross long is our anchor point. If I add in the short T-cross, so occasionally I can bring this in for you guys if you want to see it, that's not a problem. So the short-term T-cross long up here, there's a gap that between these two levels, 54.67, 53.85. That's a significant gap. The predicted high for next week is sitting at, again, 54.87, and the predicted low at 54.41. But from the predicted low down to the T-cross long, there's a gap in price that needs to be filled, a corrective gap. Now, we can also use our F8, and this is one of my favorites. You can see that this has been a very good entry point on a daily basis, right? So for the start of the week, we've got pretty strong support at 54.54 and our predicted low at 54.41. But remember, we've got a gap to fill down to that T-cross long. Now, when we look at the S&P 500 going into next week, once again, we're holding in there. But again, not a lot of gains up here, but it is very strong move for the week. So we can see the SPYs and the S&P 500 is basically the exact same trade here. So when we look at that all-important S&P 500, we're still pushing gains higher, making all new highs, 55.05 last week on the cash side. So, but the indicators are starting to turn somewhat negative here. Now, again, we're looking at a gap to be filled. The predicted low is rather high for Monday. And again, when we look at that connecting the dots between these levels, that's a bit of a problem here. I believe we need to allow this market or this gap to be filled somewhat. That gap would be down to 53.85. That's the level we would look for a corrective move, and then reassess if we want to buy into that level. My view, in my respectful opinion only, the dollar cycle plays a big part in this, where the dollar strengthens in the last few days of the month. So that's not next week, but the week after. So I believe stocks can do well next week, but not the week after, and that's because of dollar buying largely. But I also believe the S&P and your equity traders are digging their heels in, saying that cuts are coming, and they're staying along the stock market. So I wouldn't recommend fighting this very powerful trend because, again, we want to look at the primary fundamental trend. We want to look at the intermarket correlations and the intermarket technicals to decide in our trade, not just one of those three. And the fundamental and technical trend on the S&P is strongly up. So we would remain long the S&P with that in mind. Now, our European equity markets, again, Should be getting a bit of a boost here with that softer PMIs coming out of Europe. But once again, if we look down at the bottom here, we can see the DAX actually had a pretty good week, but we're still negative. Positive on the year, but negative on the quarter and the month. So right now, our T cross long is used at 18,335. In order to buy this, we need to get above that, but I'll discuss that further in a minute and how the euro is affecting this, because in most cases, they're either buying the euro, just like the US, they're buying stocks or they're buying the dollar. In Europe, it's not that much different. They're either buying into the European equities or they're buying the euro. In this particular case, well, I would argue that that's getting a bit of a boost because of that euro weakness and the dollar strength. But for now, we have a clear reversal signal. The pink line over the blue line. The medium-term strength is weakening against the long-term strength, pointing that we're at least going to move back up to the T-cross long, excuse me, and that's 18,335. We would need to get above that to confirm that we're going to stay with the primary move up while above the current yearly opening price at 16,828. Now, the VIX, again, being challenged on the current yearly opening price, very important that we look at the VIX in our stock trading. And again, this is a broader market outlook, quickly covering all the major markets that are driving the underlying markets. If we're buying stocks, we look for the S&P 500 to be higher. If we're buying gold stocks, gold miners, we look for gold futures up. If we're buying dollars, then we look for a stronger DXY. They're all tied to the main futures contracts. So right now, the VIX continues to fail this, and this is another great example of why that current yearly opening price and not a rolling performance model, moving that goalpost, that we have the current yearly opening price to tell us what is the trend of the VIX. It's still down, guys. So until we cross over the yearly opening at 1501, the VIX remains bearish. I believe the VIX will rise when the dollar strength kicks in towards the end of the month. That's something that's and we always like to be out in front of these markets, not behind them. That's why we bring in the fundamentals of the Fed and the PMIs and CPI. Look at the broader data, not just one data set. So right now, slight upward bias for the VIX towards the end of the week. Now, when we look at light sweet crude oil, this trend continues to push higher after what we've discussed with the current yearly opening price. We've crossed over the VP T-cross long, again, back on June the 10th, and we've been moving higher. Now we may have a bit of a problem. We're approaching the current quarterly opening at 82.85, and we have some at least corrective in nature, some weakness showing in the software. With that MA diff cross, you can see that our neural index is green, but the neural index strength actually is pointing down, suggesting, okay, maybe we're going to take a little bit of a break in oil prices here. So if we do, our downside target level, our T-cross long, will be 78.62. That's the level we want to look for, guys, for a corrective move to potentially re-enter longs. Okay, but again, we're firmly above the yearly opening price. We've had a test of the yearly opening price, which I pointed out several weeks ago is a buying opportunity with the same thing that put us into this trade, in short, guys, can be the same thing that takes us out of this trade. Warning that we're coming lower. Now, if you're a longer term oil trader, then I think staying in, you should be okay, but I want to get above 82.85, and I still think it's possible we can get to our $86 target by month end. Now, with Bitcoin pulling back, remaining bearish from last week, getting into summer trading, perfectly normal. But buying Bitcoin on a dip, the closer we get to mid-September, early October, that is likely the next time we're going to see a big breakout in Bitcoin. And it occurs almost every year. So mid-September, early October, there's a very clear seasonal pattern there. So potentially a little bit soft between now and then, but again, as long as we're the lowest verified zone we've got down here currently is coming in about 60,381. We'll probably test that next week, and that's the area I would keep a very close eye on, that particular area. And our secondary support comes in at 56,688. I'm actually hoping that we can get down there because it would be a fantastic buying opportunity. And in the VP, again, in the software, it's warning that there isn't a lot of downside here. We've got an MA diff cross that's taken place. And the worst thing that you could ever say about this indicator, it's always early to the party, guys. So keep an eye on that. If we see any, again, any kind of odd pricing in Bitcoin, and again, if you want to manipulate that a little bit, you can actually bring in the short, the T cross short. The further the T cross short moves away from the T cross long, the more likely a reversal is imminent. Now, when we look at some of our major FX pairs for next week, the euro is always at the top of that list because of its high inverse correlation to the dollar index, about 98% actually. So right now you can see that I've left that on here. The further that blue line moves away, which is our T-cross short, and again, as somebody had mentioned it, so I have no problem showing it on here, that's the way I would use it. The further we move away, these two predicted moving averages move away from each other, the more likely a pending reversal is coming. So we do have an MA diff cross to the upside, but the euro is structurally weak, and I wouldn't disagree. The PMIs last week didn't help it much, that's for sure. But ultimately, what's happening to these other currencies is going to happen to the dollar sooner rather than later. It may not be till August, September, but the closer we get to September, I believe the US data will deteriorate, and that's a fundamental that cannot be ignored. So again, we'll monitor things right now, but we are coming into a strong verified support low down here at 106.50 and about 106.02. I believe this area is likely to hold or maybe a slight breakdown below it, and then it reverses higher. Be very cautious of a bear trap, excuse me, down here. Same thing would apply to the British pound. When we look at the British pound for next week, again, we can see that we've got a bit of a problem once again, as we discussed in last week's outlook. This yearly opening price, it's been quite a while since I've seen such a stubborn area to break, but it's broken to the downside again. But right now, our quarterly opening is coming in at 126.31 here, guys. And again, keep an eye on this particular level. We want to get back up above that quarterly opening to see if we can re-challenge the T-cross long and the current yearly opening price. But 127.32 has proven to be very, very stiff resistance. Very tough level to hold for this pair, but ultimately I believe we go higher. But again, that's going to be there's a fundamental attached to that, which is interest rates, both the Bank of England and the Fed. But I believe the Fed is too. They're both going to cut, guys. So you've got somewhat of a standoff between these central banks. But we'll see where this goes. Right now, keep an eye on that for this week. The indicators are mixed, but they are pointing lower. Now, again, a surprise from the Swiss National Bank this past week. So they've cut again, and the Fed again is still yet to cut. So again, this is why we discuss this, guys, so everybody understands that there's interest rate cuts and hikes going on in other countries and how it's going to affect the U.S. So the Swiss, even though they were the first to cut here, the currency remains very strong against the U.S. dollar. So once again, when we look at this, there's many different ways we can manipulate this. But my view here is again that when they cut, it's a short-term move, and we can see that that's what's happened here. So it's reversed back to our T-cross long at 89.49. We would look for that area to potentially break, and that would open up the door to the potentially up into this 90.21 level, 90.34. But then we have to get above our current monthly opening price. So even with a secondary cut, that's a second cut from the Swiss National Bank, and the currency remains very strong. So once again, we'll watch these levels. The indicators are suggesting we're going higher, but we want that predicted RSI above 60 to show that we've got upward momentum, and I don't believe we do. So again, and if we do, it's short term as we gear up for additional cuts. But once again, we need to clear that level. Now, when we look at the dollar yen, the broader market remains heavily on guard for intervention here. So again, Fundamentals matter, guys. It's not just about levels and technicals and all this stuff. Fundamentals are always going to be on our list of things to look at. And the underlying fundamental here is is the Bank of Japan. If they intervene, guys, it will be on a Sunday night for sure. It could be as early as this Sunday night. But that high at 160.17, we are approaching it yet again. I have never seen this pair at this level, is all I can tell you. And again, the central banks did it to themselves when they intervened prior to the Fed starting his rate hike cycle. Big mistake. So again, we will see how this one plays out, but I would be very cautious of both a bull and a bear trap on this particular pair because this is 100% now a fundamental trade. If this carry trade starts to come unwound, it will come unwound very, very quickly. So caution, a great deal of caution is what I can advise. Now, the US Canadian pair, again, the Canadian dollar responding to both higher oil prices and strong stock, global stock, pretty much global stock market. So, right now, if we think the direct intermarket correlation here is if we think that there's going to be a corrective move lower on oil, that would mean US Canada could go higher. The interest rate, the Bank of Canada has made it very clear. Lots of cuts are coming. That's what he said. So, and it's nice to see that rationale because that's what they should have cut a long time ago. But right now, we've got support down here at 136.34 and on the monthly, and our quarterly is 135.45. This area potentially could be a buying opportunity, a short-term buying opportunity. So again, because again, structurally, if we're talking fundamentals and interest rates, nothing has changed in Canada. But this is the power of intermarket correlation. Stronger equities, stronger oil prices, that trumps a poor Canadian economy, a bank that's openly stated they're going to be cutting numerous times going forward, which again should weaken that currency, right? So we'll monitor this right now, but be careful down here because the indicators are again, if you look at the neural index strength, it's actually turning back up, not down. So that's again, be cautious of a bear trap down here. Now, ultimately, with the Aussie and the Kiwi, I believe both currencies will rise going into the third and definitely in the fourth quarter of this year. So for now, the Aussie is putting up a pretty epic battle, but you can see the way my charts are set up. My quarterly opening at 65.20, my yearly opening price at 68.20. So we are sitting smack dead in the middle of this. So the closer we get to 65.20, the more attractive longs are going to be here, guys, because regardless of all the indicators and everything that's discussed, we have held above the quarterly opening price on this pair the entire time. That actually is bullish, not bearish. So I do anticipate a bit of a stop loss hunt. I would look for longs potentially down between 65.85 and 65.20, I believe to be reasonable. But the indicators are saying in VP that we are going lower. The same thing is almost identical in the Kiwi here. We're trapped between 59.80 and 63.18. This is a bit of a dangerous area for either longs or short, and it's I want to show this in these videos so you can see that this looks very similar to a median grid. A median grid is the high plus the low divided by 2, and again, when we look at this right now, it does have an immediate bearish tone to it, but looking forwards, not backwards, because this is an outlook, not a recap of something that's already happened, guys. We look for this area down here for potential longs as the data starts to back the Fed into a corner where he's going to have to concede on these cuts. So if we get a cut if we do end up getting a cut in September, from what I've seen from the Fed's balance sheet and the Fed members, they're pricing in 2 cuts this year. And I would actually be in agreement with that and maybe even 3. But either way, 2025, it's all about rate cuts. So I believe the market, the closer we get to the fiscal year end of the US, which will be the end of September, then the dollar is really going to struggle into the US fiscal first quarter between October 1 and mid-January. So with that said, this is the VantagePoint AI Market Outlook for the week of June the 24th, 2024.